Welcome to Masters of Real Estate. Today, I have a really good buddy of mine on the line, Bronson Hill, that has now created financial freedom in his life through real estate and was able to quit his job to go into real estate full time because of his experience doing this. And I really appreciate that. It's a great story, Bronson. Can you give us a little bit about your background and, how you got started and where you're at now, man?
Sure, man. Great to be here. I love connecting with you. You came to our meetup recently, which was awesome. Got so much good feedback on that. I've just so valued your friendship over the years, man. So thanks for having me. Yeah, really excited to share. Was a well-paid medical sales professional, meaning I would wear scrubs. I'd go into heart surgery,
Oh, wow.
and a little bit intense, and I would help doctors with their heart surgical procedures. And I enjoyed it. It was great. It was very interesting. It was fun. I got paid pretty well. I was making over 200K a year, but I really wanted to have more freedom over my time. And I realized even these physicians, some of them that I knew were making over $1 million, $2 million, $3 million a year each. They didn't have time freedom. They were working 60, 80 hours a week every week. And it was hard to take vacations and
Right.
a lot of this stuff. So I kind of went down a path of really trying to figure out financial freedom and how do I get there. And my first plan was to buy single family houses. I had been doing that for years. I had a single family house in another state, and I started buying single family houses with a relative. And I got to 4 or 5 of these, and my plan was to get to 30. And then it was just a lot of work. And I had a cousin who hadn't talked to in a while who said, "Hey, this thing seems like a lot of work. Why don't you do multifamily apartments?" And I said, "Well, I'd love to, but I don't have the money." And he said, "Well, you can raise the money." So I learned about this thing called syndication, which I know you use as well, Matthew,
Mhm.
where you can basically raise big money and be able to help people with a money problem. Not that they don't have money, but they have money and they don't know where to put it outside the stock market to get a safe, consistent return. So that's really what we do. And now, 4 years later, I've raised about almost 35 million. I quit my job about 2 years ago, and I'm just loving life. I mean, it's great to be able to just have flexibility. The last 5 months, I've been to Patagonia, Chile. I went
Nice.
to Barcelona, Spain. I went to Belize. I went to Kona, Hawaii a week ago. And I just love being able to travel and write books and do different things that I enjoy. So
I say that I live through you on some of your Instagram and Facebook posts and things like that, just because I have two kids and 7 and 4 right now, and about to be 8 and 5, and after you're like, I can't get away that much when it's the two kids there like that. I keep wanting to go to these other places and travel like that. But let's go back to your experience working with in surgery. Like, I don't think I could deal with that much blood and all that stuff. I'd be like, no, I can't deal with I can't even go get my blood drawn from shots. It bothers me.
yeah,
I hate shots.
yeah.
So, but man,
What?
that's craziness. But you're going from this, high pressure environment, right? Where you're probably having to make sure you're performing. You can't go on vacations and things like that because you got to be there for the doctors consistently and help them, to obviously a real estate strategy on the capital raise side and investing in syndications, which can be a much bigger passive opportunity, right? So you can
Mhm.
actually, yeah, there's a lot of work that you do, of course, but when it comes down to the actual operation side, you don't have to do the work, which I wish I
Yeah.
would have learned a hell of a lot earlier before flipping over 1,000 of these stupid houses that give me brain damage consistently. And of course, I invest in those things now as well. But how did you kind of transition from working all those hours and, of course, being trapped into being free on this side? How did you learn that process, learn how to do the homework on your
Mhm.
deals and things like that?
Yeah, so it's funny. I just did I spoke at a conference in Phoenix recently, and I was talking about how to leave your job in 3 years. And I
Nice.
remember this kind of came up where there's that saying from the movie Office Space, where there's the Bobs there, and there's this guy, and they're trying to figure out what he does, and they're like, "What would you say you do around here?" Kind of thing. Where it's like
I
the
love
guy's like,
that
"I have
movie.
the
That's an
people
awesome movie.
skills, all this stuff."
Yeah.
Yeah, and so, but as a syndicator, just all the stuff that we do is like, well, what is it? People ask me, what is a normal? What do you actually do, Bronson? Well, I raise millions of dollars. I do podcasts. I do like, what do you do? Yeah, I have investors just think I travel all the time and I don't do anything. But really, I think what I'm learning is, it really is becoming an entrepreneur, right? When you're an entrepreneur, a good entrepreneur doesn't work in their business; they try to
Right.
work on their business. And there are times that you have to work in your business. I've got to take investor calls, which are, is great to chat with investors and make sure we get them all qualified and everything. But
Right.
eventually I want to have team members that do that, right? I want to have other people that do that. And what I want to do is create the vision for it, create the plan, do fun things like this, have interviews, be able to create content that people can consume. But a lot of kind of people wonder, like, how do you get started in this? Like, what do you even do to get started? And what I tell people is there's two things that really have helped me to 20x my net worth in 4 years. And it's really, it's nothing magical, but it's networking and education. And so if I'm just out meeting people, I know you're a huge meetup guy as well, and you went to like 4 meetups, 5 meetups a week for years, and you met all kinds of people. And that just obviously opens your mind, all different types of ideas. You meet people that like do really different things, and you're like, what could I do that? And that's how almost every investing idea I've gotten has come from meeting somebody who's been doing that, or some connection. And so that's learning. And then also education, reading books. I read about 80 books a year. I listen to podcasts. I try to do as much learning as I can. But, one thing about a business is whatever you can do, if you can create a repeatable process. So like even when we do YouTube videos or interviews or things like this, we have either a team or we've got a process, or, the YouTube videos that I record, we basically, it used to take me 4 hours or 5 hours to record 10-minute videos. Now it takes me about an hour and a half. And I just basically send it off to the team, and they take it, they post it, and then I do a little bit of work with it, but they're able to transcribe it. We have a US-based writer that turns that now into a blog. And you were talking about, being able to repurpose things before even this interview. And so we do short snippets out of it. We're able to use it in different things, whether video, audio, or text. And so I think, the biggest thing is there's a lot of people out there that don't know how to invest passively in real estate. And that's our passion, is helping them.
That's awesome. And I think that's a, huge value to be able to find ways of bringing the capital resource aspect to different investors and different deals and things like that, to be able to add that value. Because you have one set of space over here that these people are massive operators, they're doing great work, they're doing great deals, but there's a constant need for capital on their deals at all times, to be able to expand and do more and more, and be able to create that financial freedom through these investments that we all invest in, right? And so being able to do that is amazing, and that's a huge skill set. You're basically saying, hey, do the marketing aspect of this so that you have a consistent flow of content coming out to where people can understand your expertise, understand your knowledge base, and who the people you have around you are on your team as a business, to be able to add that value to them and help them create that financial freedom. And then, what are you doing on the sourcing side? How do you then source your deals to help those investors to be able to invest and add that massive value for them? Because trust me, I see this all the time. It's a huge value, because 99% of the people don't understand the, the investment aspect of this and the other side of it on the sourcing of the deals, or have this availability of these deals, right? They don't even know that they exist in the first place, which is crazy. But how do you deal with the other side and finding those investments in the first place?
Yeah, it's a great question. I mean, people wonder, why am I not hearing about these deals, or why am I just hearing about syndication now? Or, why do we only hear about stuff that's Wall Street? It's either your money person, or stuff that's on TV, or like mutual funds, or different things, which are really, just honestly really crappy investments. They're just the things, if everybody else is getting the deal that you're seeing, it's probably a really bad deal in general, just because Wall Street's going to always make money. They're always going to find a way to make money. Even if you lose, they're still going to make money. And that's not good, right? There's no alignment of interest. So really, it's the same thing I mentioned before, that how we find out about these deals is we go to networking events. We have a good network. I know you and I know a lot of the same people. And so I know you have a good deal flow, and I do as well. And it's just, the more you're in the loop, people start letting you know, hey, I've got this deal, or you start to get to know some of the operators. And I was just at a conference recently in Las Vegas, and one of the guys who coordinates the conference, a lot of people just had so many good things to say about this guy. I've invested in his deals. They've been awesome. This is what's happened. And just like, it was like 4 or 5 different people. And I've never worked with this particular operator, but like, wow, that might be a good guy to partner with. I'm just hearing so many good things from investors about it. So I try to look for, reputation, but I think just hearing about deals, obviously it's not the first deal you hear about as an investor you should necessarily invest in, but being able to hear about different deals and analyze them and look at them, you'll be able to find out who you want to work with. So I've kind of looked at, right now, our business has been multifamily. But that's become a difficult business in some ways because of the interest rates. They've gotten so
Right.
high, it's become more difficult than the pencil. So we've started doing some alternative things such as ATM machines and car washes and oil and gas deals. And we're even looking at some self-storage and other things. We just want to try to find things that make sense. We're working with great operators that really share our values. And this is something I tell passive investors is no matter who you invest with, the first question you should ask is, what do I value as an investor? And you'd think
Mhm.
everybody values the same thing, communication and, performance and these kind of things, but like figure out what your values are, and which ours are really having long-term partnerships with investors, because that
Right.
changes the way we don't approach it from a short-term level. We try to be very transparent. And then we also try to be very conservative on our underwriting. So I try to look for partners, or even if I passively invest, I try to look for people that have those same values.
Mhm.
Again, it's sometimes things we assume, but you can't always assume it because a lot of people don't have the same values that you do when it comes to investing.
Right. I think that's key. And I think those values on, being conservative in the current market are extremely important, more than an up market, right? So in an up market, you get bailed
Yeah.
out by, the economy and things like that. Right now is not the time to necessarily, hope to get bailed out. You want to look for those right operators that do think like you think when it comes to the conservative nature of those other underwriting of those deals and things like that, of course. And so, to me, a lot of this comes down to the due diligence that you do on the operator and things like that. Some of the things we do are background checks and criminal checks, talking to those investors, looking at their underwriting models and some of their deals and saying, where do they stand with regard to those, what you think a conservative assumption is versus what they do, and stuff like that. And then and I love what you're doing though in diversifying into these other asset classes. How are you going out and saying, hey, yeah, that looks like a great ATM deal to invest in, or that car wash deal looks like a good deal to invest in? What makes it pique your interest in the first place? What are the value attributes associated with those types of asset classes?
Yeah. So, I mean, every investment, and I have a book coming out soon about making money while you sleep. I haven't finalized the title yet, but it's going to basically be somebody who's only invested in stocks. How do we learn about other alternative investments? And
Right.
maybe you start with multifamily, maybe you start with some real estate assets, but eventually, you can start doing other things that are a little more creative. And so I
Right.
think whatever the asset is, it's really important to understand, well, what is the benefit of this, and does it fit
Mhm.
really what I need? So it could be a great idea, it could be a great investment, but if your primary thing is you need to reduce your taxes, well, maybe car wash investing wouldn't do that for you, or maybe there's certain things it wouldn't. So you have to figure out really what your goals are. The ATM one is just incredibly consistent cash flow. It's just like every month, like clockwork for over 10 years, it's paid out.
Right.
Doesn't mean it's guaranteed, but it's just seeing that history of like, wow, like a lot of my multifamily stuff the cash flow has decreased because the expenses going up. And even though rents are going up, we're still seeing interest costs and other things be high. So, I think it's really trying to figure out what the characteristics are. And then it comes down to, I think, I have three things that I look at when it comes to any deal in any market, really. You look at the market first. So like, for
Mhm.
example, in multifamily, we look at Jacksonville, Florida, 1,500 plus new people moving there every single month. So we
Mhm.
know the population's growing, jobs are growing, income's growing. It's landlord friendly and business friendly. It's not like California where we live, where it's hard to actually do business here. And so finding a market that makes sense. And then what is the operator? Who is the operator? What are they doing? What's their experience? They have some track record. Do they have something? Is this totally different than anything they've ever done? Or is this something that's very similar? It's in their wheelhouse. And then what is the actual specific deal? Is it actually conservative? Is it something
Mhm.
that actually, that they're not making super lofty assumptions, but they're actually saying that, hey, this is kind of a real world scenario, not uber conservative and not, aggressive, but just something kind of in the middle. And so I think, looking at those, a lot of it is reputation of the operator. A lot of it, the ATM deal I invested in previously just as a passive, and then other ones have come through relationships or reputation or things like that. But, I think you have to get a feel. It's hard if I just hear about an investment, it's like, oh, this is really great, I'm gonna raise money for this deal or partner with somebody. It's like, I'm pretty slow moving into this because you do a deal and it's like, I'm sure you've had this experience too, where you work with somebody and you're kind of like, I don't think I'd do that again, kind of a thing. Like you're like, that
Yeah.
was okay, but man, I just don't think we're kind of aligned, or, there's some things that are very different
Yeah.
about us. So I think, the older I get, the more I'm like, I just rather be patient and rather not have a deal to offer than to offer something that somebody's not gonna have a good experience in, maybe.
I think that's key. I mean, really, you can be a judge of character. You can go through all the processes. You can look at their, assumptions in the financial models, look at their reputation. But every once in a while, you're going to deal with somebody that you're like, yeah, maybe they don't have the same, mentality that I had with regard to this, and they're not performing as well or something along those lines. That's a big risk that could occur. And that's why I think it's important to diversify into the multiple operators, multiple asset classes, and not go like crazy big into one particular deal, so that way you're mitigating that risk across the board and being able to protect yourself and your investors in those things, of course. But yeah, I hear you. We've dealt with a number of those, even on the single family side. You could imagine how many of those we've had to deal with, let alone because there's usually a different sophistication level between the single family investor and the multifamily and commercial operators that, have their systems dialed in detail, of course, across the board. And I think, getting into some of the specifics with regard to the due diligence, it's the conservative assumptions like, hey, what is your interest rate going to be on refinance?
Mhm.
What is the risk profile of that deal? Are they using short-term debt or long-term debt, which then
Mhm.
adds another level of risk? Have they, assumed that the inflation rate and expenses is going to be at the right level? And the same with inflation rate on rents, or are they being conservative and not using that inflation rate? All of those little intricacies I think are important to understand when you're vetting the operator initially, like you're saying, where you're like, I got to go deep dive into this person's psyche. But even then, yeah, it's you could still take a loser every once in a while, right? And so
Mhm.
that's why the
Yeah.
diversification piece gives you that mental clarity and that emotional stability that you want in a
Mhm.
passive investment theme so that you can travel like you do, So it's awesome.
Yeah. Well, I think
Well,
we should all aspire to be full-time passive investors because, there's just, we don't know. I mean, just being able to, some people love their jobs, and maybe somebody
right,
listening is like, hey, I love what I do and I'm a doctor or I have a business, and that's great. But what happens if you get injured, or what happens if you have a family member that you need to take care of, or what happens if something comes up? I mean, you're really
right,
a single point failure, especially a lot of people that are business owners. They make money in their business, or they make money being, a high earner. But what happens if you can't do that anymore, or if something changes in the business or something? And so having these streams, a lot of people that are wealthy or they're making a lot of money, it doesn't take that long. It may take 3 to 5 years to where you become financially independent. You just figure out how much you need to live on, and
right.
that's your rat race number, right? If you can replace that number, you really have the choice whether you want to go to work or not. And they say something like 65% of people don't like their jobs, right? So just being able to have the choice of like, you can, there's this old country song. It says, "You take that job and shove it," and it's really funny, but it's just that idea that like when you can do that and you can be like, take your job and shove it. No, not mean to disrespect, but just like you can say, I don't want to do this anymore. And I have that choice. And it's awesome. Actually, when I left my job, it's really interesting. I left my corporate job. My boss, there was a boss's boss who kind of saw what I was doing and didn't like what I was doing. And so when I left a month or two later, I said, "Hey, what's Bronson doing these days?" Well, he's just doing real estate. He's like, "Oh, how can he do that?" He didn't understand like how I had the freedom to be able to do that. And that's the thing, that when people start to experience passive income, it's
Mhm.
not, in my opinion, it's not owning a rental house. It's not running a business where it's being able to vet a team, vet a deal, and then just be hands off. And I think
Right.
that's the really awesome thing about it.
And once you start seeing how much money you can make in real estate, it did what it did for me, which was made me quit my job at my CPA firm. And of course I
Yes.
did it in 2006, right before the crash. So I was a real estate genius about a year and a half before I got my ass handed to me. But you learn the lessons the hard way. But
Right.
at the same time, that's the key, right? It gives you that freedom to say, hey, I'm done with that. I'm tired of this miserableness, with this job, or I'm just not happy there or whatever. Or maybe you just don't need to do it anymore, and you were happy at your job. You just don't need to, though, So
Yeah.
I think it gives you that massive freedom. Now, let's talk a little bit more about some of the different asset classes. I like what you're focused on the multifamily side. A lot of people, including myself, have been investing in that for years. There's massive tax benefits via cost segregation structures on those types of deals. There's big value add benefits, of course. What are the risks you're seeing in those deals right now, and making them not pencil for the most part?
Yeah, I think really, well, there's a few things. I spoke at this conference recently that I was talking about. I think right now, recording this early May, it's about 5 times as hard to do deals right now, I think. And
Mhm.
I think it's for reasons that, you're having to raise sometimes twice as much money. So instead of 20% down, it's 30, 40, 50% down. You're raising
Right.
twice as much money. And investors are half as likely to give it to you. Right. So people kind of have this concern of like, even if it's a great deal, it's like, oh, I don't know. Is it risk? But in reality, like the best time, it could be a great time to invest, could be a great deal. but it's been challenging to get the numbers to pencil. Now, in reality, it probably is a safer time now because you kind of know a little more what the risks are. And if we're if it ends up being this is more kind of peak rates, or we're getting, 25 to 50 basis points off of peak rates, then it would be a great time to invest, because as rates come down, valuations will go up. But I think, just in general, I think, we're always looking for deals. We're always looking for things that make sense. I've noticed, I think the volume of large multifamily deals is around 75 to 85% down from a year ago. I've heard different reports of this just in the lending side as well as the transaction side from brokers. So it is looking a little different. So I think there's some kind of new risks that are there. A lot of it is, the risk is, do the numbers still make sense? What if rates go higher? What if, rents don't continue to rise? I mean, there's just some things that we look at that, we haven't seen it in the markets we're in, but there are markets where rents are coming down. And so you have to kind of figure out, okay, could this deal get in trouble, and how could it get in trouble? And is it worth going for it? And so that's always an evaluation in any deal you do. There's always risk. You always have to evaluate them from a very sober perspective. And there may be, if you can identify it to 1 to 2 primary risks, most of the time in multifamily deals, it's just, are we able to perform on what we said we're going to do? Are we able to actually work the plan? If there's an issue, it usually comes down to that, but there could be external things too.
And it definitely comes down to the operator's ability to stick and move also in these kind of circumstances, for sure. And so that integrity and the homework you did on that operator matters a lot. Now, sometimes there's things that they can't do, and there's different risks that were inherent in the original investments. So like a lot of the people, I think where the major distress is going to come from in the multifamily space comes from the people that did short-term debt initially to do their value add, and then didn't have the right underwriting on the back end with regard to the interest rates, because they changed so quickly that, they were then not able to refinance now at what they thought they were going to be able to refinance and be able to get, the right debt load there. So they might have to have capital calls, which might be at a lower return on investment and harder to raise the money, of course, like you were saying. And so then they have the risk of losing the whole investment and going back to the bank at a time when the commercial mortgage-backed security market is in shambles and nobody wants to buy commercial mortgage-backed securities. And so, and at the same time, when like a massive amount of these types of loans are going to be coming due in the next couple of years, when you're talking about retail and office space and multifamily all combined, it's a massive debt load that needs to be refinanced. And so if you're in that position as a multifamily operator, you're going to be in a tough spot. And so to raise that capital, and I think that's going to lead to a lot of opportunity in the next few years after this kind of shakes out a little bit, to see what happens, to see if maybe the banks do workarounds on some of the debt a little bit to make sure some of those don't default, or maybe they take back a lot. And it's time to go make those relationships with the banks now that have a significant amount of exposure, and then we have the other aspect of that, where the banking sector as a whole, the smaller banks, which typically fund 40% of the overall commercial debt market, are in financial turmoil because of the banking issues that we've seen, and the push of cash to big banks from smaller banks out of fear of, insolvency, right? So all of these things combined seem like a perfect storm for a massive amount of distress in the commercial segment, as well as, we had major office space reductions and occupancy rates and things like that, which maybe that debt on the banking side has not been written down yet to market. And so with all of this stuff combined, it's a little scary, but I think there's going to be a lot of opportunity. It's like we're weathering the storm at this time until that opportunity starts to present itself on the back end. Do you agree?
Yeah, I mean, these things, they always lead to opportunities. There's always opportunity. And, this is actually a question that comes up a lot. And this came up at a recent event. Is it best to wait and save cash, or is it better to just invest it all right now? That's a good question, because I actually love to hear your opinion on this too. But, it's some people would say, and I have really smart friends, and we both follow some people like George Gammon and other people that are sitting in cash and are just like, oh, I'm just waiting. But I think inflation is about 15% or higher. And I think if people have been waiting for the last year, because really that's when rates started rising,
down 15%.
They're down 15%, just a purchasing power. You were seeing it like a Chipotle burrito 2 years ago that I'd buy was $7.50 is a chicken burrito. Now it's $11. Like I can see that directly. That's like a
Yeah.
50%
Right.
increase. So it's like, you can't say that, so you can actually have the same amount of currency, but have way less purchasing power.
Mhm.
And yet I wonder if somebody were to wait a year or two, would the 15 to, 30, 40% decrease in the value of your
Yeah.
currency be worth waiting? So I'm actually of the opinion it's better to deploy as much as you can in deals that make sense, that are safe deals. So I'm about 95% deployed, kind of just regularly even through this market. I
Uh-huh.
know other friends that are just hoarding cash, but what are you doing? How are you facing that one?
So I think it's a matter of understanding that, hey, if there is inflation, yes, you might have, as long as you have long-term debt, so you don't lose the asset. So,
Right.
capital preservation is number one when you're investing. Okay. And then after that, you're looking at, okay, well, if I'm producing X amount of cash flow, even though the inflation is here, but inflation is decimating this amount of the debt also, as far as equity goes, how am I faring overall in relation to what I think the inflation rate is? Which inflation is different in every aspect. I think Shadow Stats probably has it at 15 to 20% right now,
Hmm.
like you mentioned. But and food inflation and all those things are massive. Now, there is another risk that I see out there as well with regard to people's true affordability ratios, which, when
Hmm.
you're looking at the side of things with regard to their credit card debt, their house payments, their car debt and auto debt, they have their affordability for qualifying for loans on mortgages or qualifying for rents, for example, and seeing if
Hmm.
they can afford it. But that doesn't show you the whole picture of, we just talked about a 50% increase in food prices, right? And
Hmm.
that's food prices is the next biggest expense, probably other than mortgages, right? They're your housing. And so looking at those types of things, I think is important to understand people's true affordability on the risk side. And so I'm taking that into consideration as well. But I think diversifying into real estate as well as non-real estate asset classes that hopefully hit a high enough return to outpace that inflation and have some upside potential as well, potentially even taking on some additional risk to hit that inflation goal, but at the same time really mitigating what you see as the bigger risk of losing capital, right? So
Hmm.
that whole piece is capital preservation is the name of the game right now. Having some cash is great, but just for emergencies and things like that, or assets that can be easily recapitalized to get your capital
Right.
back. Like we
Right.
invest in a lot of short-term debt that I can go sell that debt off and get my capital back out of that relatively quickly if I needed to, right? Versus real
Mm.
estate is a little bit more illiquid than that, right? So I think being able to have liquidity without the liquidity is the key, right? So
Mm. Yeah.
and I know you go invest in a lot of precious metals and things like that, but you're able to keep your liquidity up with that, right? Can
Yeah.
you talk a little bit about that, your positions in that aspect of things and how you focus there and how
Yeah,
you
so we buy. Yeah, I got introduced to this strategy through my friend Russell Gray. Let's see if I have my gold bar, my gold nugget up here, right? So my
nice.
fake gold stress ball nugget. But just the idea with metals, I didn't really get this. I just thought, man, why would people, okay, you buy gold and silver, that's great, they're shiny, but what does it mean? And is it an investment? But the way I look at it is, it's actually for 5,000 years, gold and silver have actually been money. And back up to the 1930s, you could go into a bank and on the $20 bill it said payable to the bearer in demand on demand in gold. And so you'd get a 1 ounce gold coin for a $20 bill. And so it was a claim check on the actual money, right? And I know you're
Yeah.
very familiar with it, you're a metals person as well. But I didn't really realize how it actually is money. So the gold and silver I own is actually not an investment. It actually is money, but it's harder to go spend, right? It's harder to just like, I'm going to take a gold coin and go buy, things or a car or a house. But there's a way that you can actually own a bunch of physical metals. You can store it at a vault. There's one outside of Vegas called TDS vaults. And basically you can store them at different vaults and you can borrow against the value of the gold or silver at 75% loan to value. So what that means is you can basically go in and say, hey, I want to have almost like a HELOC on the value that's there. I can borrow 75,000 of the 100,000 of gold or silver.
Mm.
And it's typically something like 7 to 9% or somewhere in there. And it's only for the number of days that you actually use it. So if you need it for some hard money for a loan, or you need it for a short-term expense or something, you just pay it back whenever you're able to pay it back. And so I found it to be really great to, instead of storing money in cash, to store money in metals. And then it provides me the ability to hedge inflation, because actually there was a time where when inflation was really heavy. And there is some speculation around it too. And gold
Mhm.
actually became legal to own again because it was illegal to own between 1933 and 1974, which people don't realize. The government made it
Right,
illegal. 1974. Then from 1974 to 1980, the price of gold went from $20 to $850 an ounce, which is like a 25x or something like
right.
that. So there are these big moves in metals. And so I just see the more currency that they print, it actually is an insurance against that so
Mhm.
that it will just generally rise as they create more currency. And there's a global demand for it. So central governments all around, I know, both you and I are a little bit into conspiracy stuff. It's like, they're buying metals all over. Why are they buying gold and silver? Well, they're
Right.
especially gold because it's a monetary metal. It's something that they can use to back currency or other sorts of things, or even Iran will actually trade, oil in golds because it's not traceable, and there's other
Right.
countries will do that as well. So I love investing in metals, and of course that precious equity strategy where you can borrow against it is pretty cool too.
I really like that strategy, both because you can now be invested in gold and silver and take that gravy train up. Now we could have some volatility where it comes down first when the market typically crashes and then goes crazy up. After that, of course, that's what we've seen historically. But at the same time, this can't really base historical off of the future anymore because there's too many,
Right.
changes. But what's crazy is that you get to take that ride up and hedge yourself there, and then on top of that, you're paying back the loan in dollars, which is being deflated at the same time, which is really interesting, concept to be able to do that and have that hedge right there on both sides. And then you can go invest it into real estate or something like that so that you can go
Hmm.
and that now hedge that cash inflation even further, which is pretty cool. So
Hmm.
just being able to see, the leverage aspect of that and taking advantage of the inflation that's occurring is key. And so
Hmm.
that's an awesome strategy. So can you kind of go over your general overall like philosophy for investing in the near future over the next 12 to 24 months, and the main things you're focused on to diversify your investments into these different asset classes?
Yeah, I think right now there are a lot of people very afraid. I talk about this a bit. Bloomberg came out with an article late 2022 that said that Americans have over 5 trillion right now in bank accounts and in just investable accounts, and that's it's over 4 times what they had in 2020, which was the high before. So,
Mhm.
1.2 trillion up to now 5 trillion or higher. A lot of people are just sitting on the sidelines. So,
Mhm.
my thesis is okay, maybe hold a little bit of cash, but I think, most people are holding cash. So I think there's a lot of money to be made in being a contrarian. And if you're buying in the right demographic, the right trends, I mean, from a number standpoint, multifamily is an incredible investment. We're short somewhere between 3 and 8 million apartment units,
Right.
depending on which study you look at. There's multiple studies that show we're just way short of housing, particularly in certain markets that are growing. And so I'm a big fan of just getting behind the trend. My friend Ken McElroy says this: if you can just get into trends. A big trend also is in senior care and sort of anything related to seniors because people are getting older, right? So if you can
Right.
just be ahead of any trend. But I think in general, it's important to watch out for, I think there's a difference between just deploying money just because it's time to deploy money and really
Right.
waiting for the right types of deals.
Right.
We are doing some alternative stuff to hedge kind of some of our risk. Some of the ATM stuff and car washes provides a lot of cash flow. I actually just had a meeting with an investor guy that I know who's in his 80s, and he's probably worth between 200 and 500 million dollars. And he was just saying like there's two types of deals. He's like there's real estate deals that are kind of long-term appreciation type of deals, and then there's cash flow deals. And he does a lot of investing in car washes and franchises and other things like that that provide cash flow. So I think that's cash flow is always great. If I was gonna have one, I'd have
Yeah.
cash flow all day long because it pays for expenses, it pays for your
Right.
life, it pays for everything. But having long-term, high appreciation can be really valuable too. So I think it's important to pay attention. It's important to have a strategy to educate yourself. I always say the best education, the best investment somebody can make is in their own education. And so things like this, there's books, there's other things out there, but I think really being proactive, finding things that make sense for you. Even you mentioned it, if there's interim term investments or something where you get half your money back in a couple of years or something like that, where you have the ability to kind of cash flow and then redeploy, or maybe you have the ability to get liquidity out of something you can cash out within 90 days or a year. That's pretty beneficial too.
That's awesome. Yeah, I think that cash flow gives you a massive amount of stability that you don't see in typical environments. So being able to have that strength of that cash flow stream to know that you're taken care of is key, right? So, well, this
Right.
has been awesome, Bronson. Thank you so much. How can people reach you if they want to get a hold of you, man?
Yeah, I love connecting with folks. We have our investment club. We've got a resource called "How to Use Inflation to Your Advantage." So a lot of people are interested in that. How do I not get pained by inflation with the food prices or the gas prices, but actually use it on the other side of the equation where you get to use it to your advantage? So that's at my website, bronsonequity.com. We also have a YouTube channel just under Bronson Hill. You can reach out. Feel free. We're on all the social medias, but look forward to connecting with everybody. But thanks for having me, Matthew. It was a lot of fun.
Thanks a lot. I appreciate it, man. Good talking with
Thanks.
you. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.